Hi, in this mini lecture we're going to be focusing on the third learning outcome for Chapter 6, and that's to analyze purchase transactions under a perpetual inventory system. Well, this chapter is about merchandising operations, and merchandisers are companies that purchase goods we call inventory, and then they mark them up to sale prices and sell them to us. Either as retailers, they sell directly to consumer, or as wholesalers, they sell to retailers. But in any case, they don't create the merchandise that they sell, they buy it. So let's learn first how to purchase inventory, and then we'll learn in Learning Outcome 6-4 how to record the sales of inventory. Okay, so in recording inventory purchases, we demonstrate the accounting for inventory purchases as well as transportation, purchase returns and allowances, and purchase discounts. We'll be learning how to do all of these. Now, it's important that we record all inventory transactions directly into the inventory account because we're learning a perpetual inventory system which is always kept up to date. Okay, first let's talk about purchases. Remember, the inventory account itself is an asset. Specifically, it's a current asset because we expect to sell that inventory and turn it into cash within 1 year. When we record the inventory account needs to be debited because that's how we increase the inventory account. And most times when merchandisers buy goods to be resold, they don't pay in cash. Normally they have a credit relationship with their supplier. So we credit the accounts payable account because that's how we increase liabilities. Okay, so let's look at our example here. Walmart receives $10,500 worth of merchandise purchased on account, which means on credit. So we debit the asset inventory to increase it and credit accounts payable to increase that. You may wonder, when should you record this purchase? Well, it depends upon when delivery is made. And the way we determine delivery is through transportation terms. So let's talk about those. The transportation terms determine not only who pays for the transportation costs of getting the merchandise to the merchandising company, but also they determine who owns it when. So if the terms are FOB shipping point, the ownership of the goods is transferred right at the shipping point when they leave the seller's shipping department. The sale is recorded. Why? Because the ownership transfers right at the shipping point or shipping department. From that point on, the buyer owns the merchandise or the inventory. So the buyer or purchaser has to pay for the transportation costs. They bear the risk of loss from the moment they leave the seller's shipping department. And the seller at that point can record revenue. They can record a sale, and we can record this purchase journal entry. If the terms are FOB destination, then ownership does not transfer to the buyer until they reach the buyer's place of destination, wherever the buyer wants them delivered. So the sale is recorded when the goods reach their destination, which is the customer's place of business. So the supplier pays for the transportation because they own it until it's delivered. Now, what does FOB stand for? It's an old-fashioned term that means free on board or no charges until. So no charges until shipping point means the buyer owns it from the moment it reaches it or leaves the shipping department, and therefore since the buyer owns it, the buyer pays the transportation costs. FOB destination means there are no charges until it reaches the customer's preferred destination. So since the seller owns it during shipping, the seller pays for the shipping or transportation costs. Now let's look at the journal entry for FOB shipping point, because we're looking at the purchase journal entries right now. If the terms are FOB shipping point, the buyer or purchaser has to pay for the shipping costs. And look, we add it to the inventory account. That's because the inventory costs us more if we have to pay for shipping. Think about when you buy something online, maybe a shirt, and you think you got a really great deal because the shirt's only $10, and then you find out that the shipping costs add another $10, and your $10 shirt really cost you $20. Well, that's what we're basically reflecting here. The inventory costs us $200 more because we have to pay for shipping because the terms are FOB shipping point. If the terms are FOB destination, then the seller or supplier pays, and they would debit a delivery expense account. But we'll talk about that when we look at these journal entries from the selling viewpoint. Now let's talk about purchase returns and allowances. Okay, you're probably familiar with what a return is. A return is when we take something back to the store, right? Well, when goods purchased from a supplier arrive in damaged condition or fail to meet specifications, perhaps they're the wrong merchandise, then the buyer can either return them for a full refund, which means to have their accounts payable account reduce, or they could get a cash refund if they paid cash, but that's fairly unusual. Or instead, they can agree to keep them and get a cost reduction, which we call an allowance. So let's assume Walmart returned some of the merchandise and received a $500 reduction in the balance owed. So the return is the opposite of the purchase. Here's the purchase up here, debit inventory to increase it, credit accounts payable to increase that account. The return, or the allowance, is the exact opposite. We debit to reduce the amount that we owe, and we credit to reduce the value of the inventory. Now, you could understand why a return would result in this entry, because you're taking the merchandise back. But why does an allowance result in this entry? Because you're keeping the merchandise. Why would we credit the inventory account? We would credit the inventory account because it costs us less, since we're getting a price break. So both the amount we owe is reduced and the cost of the inventory is reduced. So both for a return and an allowance, we use this journal entry, and it's the opposite of the entry to purchase the merchandise. Last topic, and that deals with purchase discounts. And a purchase discount is a cash discount that the buyer receives for prompt payment on their account. Now, there's two ways to account for purchase discounts, both the net and the gross method. We're going to be learning the gross method, which means we don't record a discount until we actually take the discount. But the net method is sometimes used when companies routinely take discounts, and in that case, you would record the inventory at the amount less the discount right when you buy it. Okay, so we're learning the gross method, and I'll show you how that's reflected. First of all, we've been using it up to this point, but also we'll show you what this looks like in our payment journal entry. When inventory is bought on credit, terms like 2/30 and /60 may be specified. The 2 represents the discount, and 30 is the number of days that you have to pay in order to receive the 2% discount. N stands for net. That means the net amount, which in our example would be $10,500 less the return of $500, which is a net amount of $10,000. The net would be due in 60 days. You may also see this reflected as 215 and 30, or it could be 110 and 15, whatever the seller wants to offer as the discount terms. In this case, 2% discount would be offered to the buyer if they pay in 15 days. If they don't pay in 15 days, the net amount, the purchase less the return, is due in 30 days. Okay, so you are allowed to take the discount only on the goods that you keep. So we would have $10,500 originally purchased, less a $500 return means $10,000 is owed. So we debit the accounts payable account for the full amount that's owed. But we're not going to pay the full $10,000 because if we pay in this case 30 days, we're going to be able to take a 2% discount. So if we multiply 2% times the $10,000 that we owe at that point, that equals $200, and we're going to credit the inventory account for $200. Now, why would we do that if we're not reducing our inventory itself? Well, we're not reducing the quantity of our inventory, but we're reducing the cost of our inventory. We're paying less for it because we're paying early. So our credit to cash would be for $10,000 less the $200 discount, or $9,800. And our debit to accounts payable would be for the full amount. Now, in our next video, I'm going to be demonstrating how to do a solution for one of the problems that I've assigned for homework. But I want to mention to you that as you're doing homework problems for this chapter, if you keep handy your accounting essentials notes, the entries for the buyer and the seller are part of that packet. And that kind of summarizes the journal entries. Okay, so we'll see you in the next video. Have a great day.